Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today, we're looking at Cameco.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis.
Okay, let's set the stage. This company is a real heavyweight in the nuclear fuel space. So what does the recent data tell us about its fundamental health, especially on the revenue side?
Well, the growth it's pretty staggering, actually. Revenue surged 21.2% year over year.
21%, wow.
Yeah, it climbed from about CAD 2.6 billion in 2023 to over 3.1 billion in 2024.
So this isn't just a small bump.
No, not at all. And it's not just, a simple commodity price spike. This is really about strong execution on their long-term contracts. The money from those is finally flowing through.
Okay, that's a strong top line. But what about profitability? I mean, are they managing their costs well during this big growth phase?
They absolutely are. The net margin is solid. It's holding at nearly 15%. I think the 2025 number is 14.97% to be exact.
That's healthy.
It is. But here's the really interesting part. What a lot of people are calling an earnings catch-up story is finally unfolding.
An earnings catch-up. Break that down for us.
It just means that the profitability, the real cash flow, is now catching up to the great contracts they signed a while back.
I see.
If you look at adjusted EBITDA, which is basically a good proxy for cash flow, for the first 9 months of 2025, it hit $1.3 billion.
And how does that compare to before?
It's significantly higher. It proves that those higher price contracts are kicking in and really boosting their operational earnings.
So the market is starting to see the true financial power here. What about the outlook? What's management saying?
They sound very confident. They recently reaffirmed all their production and delivery targets for the full year.
Okay, so holding steady.
Actually, better than steady. They tightened their uranium sales guidance to between 32 and 34 million pounds.
So they narrowed the range.
Exactly. And when a company in a sector like this tightens its guidance, it signals, a huge amount of confidence. They have real visibility into their operations.
That level of visibility, it really does suggest they're more than just a typical miner. Which brings us to their core advantage, their moat.
That's the key. This isn't just a miner, it's a vertically integrated nuclear fuel platform.
What does that actually mean in practice?
It means they do everything. They're one of the top 2 global uranium producers, sure, controlling something like 17% of the world's supply in 2024. But that's just the start.
So dive into that strategic difference for us, that integration, and especially their stake in Westinghouse.
Right. It gives them what we call full fuel cycle exposure. So think about it like this.
Okay.
They control these incredible high-grade deposits in Canada. Then they operate the services to turn that raw uranium into usable fuel. And then, with the Westinghouse stake, they're involved in the reactors themselves.
The whole supply chain.
The whole thing. And that creates incredibly high switching costs for their customers, the utility companies.
Why is that?
Because for a utility, security of supply is everything. They can't risk any disruption. Cameco gives them a one-stop shop that's reliable, predictable, and, this is critical, Western aligned.
That Western aligned part is huge right now. And that big news from October 2025 really cemented that, didn't it?
It was a complete game changer. That partnership with Brookfield and the U.S. government, it wasn't just a business deal.
It felt more like a strategic policy move.
Exactly. It positions Cameco as the preferred supplier for the West. It supports the U.S. nuclear build-out. It supports SMR deployment.
The small modular reactors.
Right, which are the future. And it helps extend the life of existing plants. All of this is happening while everyone is trying to reduce their reliance on Russian supply.
So when the board sees that kind of tailwind, you'd expect them to signal that confidence back to the market, did they?
Oh, they did. Big time. They roughly doubled the annual dividend to 24 cents US per share.
Doubled it. That's a pretty strong signal.
It's a huge sign of confidence in future cash flows. They're basically saying we have so much visibility that we can increase shareholder returns even while we keep reinvesting heavily in growth.
That says a lot. Okay, but for a capital-intensive business like this, we have to look at the foundations. How's the balance sheet? Is it flexible?
The balance sheet is, it's highly liquid. We call it net cash-like.
What are the numbers?
As of the third quarter of 2025, they were holding about $779 million in cash. Total debt is $1 billion, but they also have an undrawn $1 billion credit facility just sitting there.
So they have plenty of room to move.
Tons of flexibility. The debt-to-equity ratio is just 0.15, which is very low.
That's important because operational risks are always there. I know Q3 saw some production cutbacks, so how do they handle a shortfall like that without breaking their contracts?
This is where their risk management really shines. So, yeah, volumes were a bit lower in Q3, but instead of panicking and buying on the open market,
Which would have been expensive.
very expensive, they managed the situation. They actually reduced the amount of uranium they expect to buy on the market for 2025 from up to 3 million pounds down to just 1 million.
Wait, how do you buy less, but still deliver what you promised?
They used standby product loan facilities.
Okay, explain that.
It's like having an arrangement where they can borrow inventory from a partner to make a crucial delivery on time. It let them preserve their own cash and inventory, avoid high prices, and still hit that tightened delivery guidance.
That's a pretty sophisticated move. No wonder the big investors are interested.
For sure, the institutional belief is really strong. Ownership is over 70%.
And who is buying?
You've got these large, sophisticated, long-term investors. Think Temasek Holdings, British Columbia Investment Management. They were actively increasing their stakes in the second quarter.
So they see any short-term dips as a chance to buy.
That's exactly right. It really underscores their confidence in the long-term story here.
Okay, let's pivot to the technicals. The fundamentals seem solid. How does the stocks chart look?
Technically, the stock is in a very strong multi-year bullish trend. It's trading up near the higher end of its 52-week range, which goes from about $35 all the way up to $110.
And what about support levels? For potential buyers looking for an entry point.
The key long-term support is the 200-day simple moving average. It's holding strong right now in the $66 to $70 range.
So as long as it stays above that, the trend is intact.
Exactly. And right now, the momentum is pretty neutral. The 14-day RSI is around 52, which means the stock isn't overbought or oversold. It's actually a pretty constructive setup for accumulation.
Okay, now let's tackle the elephant in the room. Valuation. We keep saying it's a premium asset, but
Yeah.
the multiples are high. Is the valuation stretched?
Yes, let's be clear about that. If you just look at the trailing PE ratio, it's in the high double, sometimes even low triple digits. It's high.
Right, and that's the main risk, isn't it? The primary bear case.
It is. This has led to headlines about it underperforming and some analysts lowering targets. The risk is that it's priced for perfection, leaving no room for any missteps.
So why are the big institutions still buying? Give us the bullish context for that premium price tag.
They're paying for what the company represents for the future, not what it did last quarter.
Right.
First, you're paying for that integrated fuel cycle exposure. Second, you're paying for the scarcity of high-quality Western uranium assets. And third, you're paying for the massive optionality from the Westinghouse stake and the U.S. partnership.
So the idea is that earnings will grow into the valuation.
Precisely. The bull case is that the premium compresses because earnings accelerate so quickly into 2026, not because the stock price falls. It's a bet on future growth.
A crucial distinction. So looking forward, what are the specific catalysts we should be watching over the next 3 months or so?
The biggest one on the calendar is the Q4 2025 earnings release. That's expected in early February.
And what will the market be looking for there?
They'll want confirmation of that strong growth from higher realized prices and, really importantly, a growing contract backlog. A beat there could be a major catalyst.
What about other things, maybe things that aren't tied directly to the company's performance?
Well, in December, you could see some ETF rebalancing, which can cause some, unusual volume or price swings.
Right, the index funds adjusting their holdings.
Yeah. And then in January, we get the institutional 13F filings. That's where we'll see hard data on whether those big players were still accumulating shares at the end of last year.
So moving beyond the next quarter, what are the big multi-year themes that support this as a long-term hold?
I'd say it's riding four major waves. The first and most obvious is the nuclear renaissance. Global policy is pushing for zero-carbon energy, and that means structural demand for nuclear fuel.
Okay, number one. What's the second?
The second is AI power demand. And this one is, it's becoming a really big deal.
The AI connection, this is fascinating.
It is. The build-out of these huge data centers requires massive amounts of stable baseload power.
Power that's on 24/7.
Exactly. Solar and wind can't do that alone. So governments are now explicitly looking to nuclear to power the AI revolution. It's the only reliable high-density source that fits the bill.
That's a huge, almost unexpected tailwind. What are the last two?
third is that geopolitical alignment we've been talking about. De-risking from Russia supports higher structural prices and favors a company like Cameco. And finally, the Westinghouse synergies.
Right, the auctionality.
It's massive. We're talking about potential high-margin fees from new reactor tech like SMRs and service contracts. It's growth beyond just digging stuff out of the ground.
So to put it all together, what we really have here is a story of a premium asset, a kind of integrated energy platform, not just a miner. It has strong momentum, a solid balance sheet, and a competitive moat that's getting deeper.
That's a perfect summary. And yes, while the stock has had some of that valuation digestion, which is normal, the combination of everything we've talked about, the balance sheet, the strategic advantage, and this overwhelming structural demand, it sets up a very attractive risk-reward for anyone focused on multi-year wealth creation.
That's all the time we have for today. Thank you for tuning in to Smart Wealth with Joshua. Don't forget to subscribe, like, and share to stay ahead of the curve.